One of the main factors that could drive oil prices higher is the supply situation. The global oil market is facing a supply crunch as OPEC Plus and Canada reduce their production levels. OPEC Plus, which is an alliance of OPEC members and other major oil producers like Russia, decided to cut its output by 2 million barrels per day starting from November. This was a sharp reversal from its previous policy of gradually restoring the production that was slashed during the pandemic. The group said it made this decision based on the uncertainty that surrounds the global economic and oil market outlooks. The OPEC Plus production cuts have a significant impact on the global oil supply, as the group accounts for about 40% of the world's crude oil production. According to the International Energy Agency, IEA, the OPEC Plus agreement, along with declines in production elsewhere, including the United States, brought global supply lower than the level of global demand for the first time since mid. Another major oil producer that has reduced its supply is Canada. Canada is one of the top exporters of crude oil to the United States, which is the world's largest oil consumer. However, Canada has been facing several challenges that have hampered its oil production and exports. These include pipeline bottlenecks, environmental regulations, wildfires, and labor disputes. According to the IEA, Canada's oil production fell by 300,000 barrels per day in September 2022 compared to a year earlier. This was mainly due to maintenance shutdowns and unplanned outages at some of its oil sands facilities. The IEA expects Canada's oil production to remain below pre-pandemic levels until at least the combined effect of OPEC Plus and Canada's production cuts is a tighter oil market, where demand exceeds supply. This creates upward pressure on oil prices, as buyers compete for scarce barrels. The IEA warns that higher oil prices could push the global economy into recession, as they increase inflation and reduce consumer spending. Therefore, it is clear that the OPEC Plus production cuts and lower supplies from Canada reduce the global oil supply and create a tighter market. This could make oil prices glow higher thanks to gasoline demand, which is expected to remain strong as economies recover from the pandemic. The U.S. debt ceiling talks and the SPR release are two factors that could affect the oil market sentiment and outlook in the coming weeks. Here is how. The U.S. debt ceiling is the legal limit on how much the federal government can borrow to pay its bills. If Congress does not raise it by June 1st, the Treasury Department will run out of money and risk defaulting on its obligations, which could trigger a global financial crisis and a sharp rise in interest rates. The debt ceiling talks have been stalled by partisan disagreements over how to limit federal spending and raise revenues. The White House and House Speaker Kevin McCarthy's office have been holding direct negotiations since Tuesday, but they have not reached a deal yet. A debt ceiling crisis could hurt the oil market by reducing the demand for oil and fuel products, as consumers and businesses would face higher borrowing costs and lower confidence. It could also disrupt the supply of oil and gas, as some federal agencies and programs that regulate and support the energy sector could be shut down or delayed. The SPR release is the decision by the Biden administration to sell some of its Strategic Petroleum Reserve (SPR) oil to replenish the fund that pays for it. The SPR is a stockpile of crude oil that the U.S. government keeps for emergencies, such as wars or natural disasters. The Department of Energy announced on Monday that it will buy up to 3 million barrels of oil initially for the SPR under a three-part replenishment plan. The plan also involves selling up to 20 million barrels of oil later this year and next year, and swapping up to 50 million barrels of oil with private companies. The SPR release could affect the oil market by adding more supply to the global market, which could lower the price of oil and gasoline. However, the impact may be limited, as the SPR release is relatively small compared to the daily global oil consumption of about 100 million barrels. The SPR release could also signal that the Biden administration is concerned about the high energy prices and their impact on inflation and economic recovery. It could also reflect the administration's strategy to diversify its energy sources and reduce its dependence on oil imports.